Whether you are currently building a portfolio or are looking to enter the market, protecting your capital is a top priority. Understanding how to hedge your assets, specifically stocks, gold, and silver, is essential for long-term financial security. You wake in the morning, checking your bank account, and seeing that the balance is the same, but your buying power has vanished. The money you worked so hard for is suddenly worth a fraction of what it was yesterday. This isn't about a stock market crash or a bad investment. It's about a sharp, sudden drop in the value of the dollar. If you are currently invested in stocks, gold, or silver, or if you're planning to be, you need to understand how to protect your wealth before the floor drops out. It sounds extreme, but it happens more often than you might think. Countries you wouldn't expect, with stable governments and growing economies, have faced this reality. And when it does, it doesn't just hurt big companies, it hits regular people, students, and young professionals the hardest. Today, we're going to explore how a sudden currency devaluation can quietly erode your savings and investments, and more importantly, how you can protect yourself without taking unnecessary risks. Currency devaluation is when the money in your wallet loses its purchasing power quickly. It's not inflation that rises gradually over years. This is a sharp drop, sometimes overnight. To give you a simple example, imagine you keep $10,000 in your local bank account. Overnight, your currency loses half its value. That $10,000 can now buy only half as much as it could yesterday. Your salary, your savings, and even your investments denominated in local currency suddenly feel smaller. For someone just starting their career, maybe paying off student loans or saving for their first apartment, this can be devastating. And the scary part is, many people don't see it coming until it hits. Now, before we get into strategies, it's worth understanding why this happens. Usually, it's a combination of economic policies, government debt, trade imbalances, or even political instability. Sometimes it's global events like a sudden shift in commodity prices or interest rate changes abroad. The key point is, even if you're careful, external factors can suddenly make your money worth less. Let me tell you a story. Imagine Anna, a young professional in Europe working her first job after university. She has been diligent, saving a bit each month and investing in a local stock market index fund. She feels secure after all. She's following conventional advice. One morning, news spreads that her country's currency has lost 20% of its value in a week due to government debt issues and declining exports. Suddenly, Anna realizes that the investments she thought were growing are now worth much less in real terms. Even her cash savings, which she considered safe, lost value overnight. This story isn't unusual. While 20% might sound dramatic, history shows there are real-world examples. For instance, Argentina in 2001 or Turkey in recent years. And while these may feel distant, the lesson is universal. Money stored in one currency can suddenly behave unpredictably. Here's why this can feel worse than a stock market drop. When the value of money drops, you experience what economists call a loss of certainty. Unlike a stock where you can see gains or losses on paper but can hold your position, cash losing value hits everyday decisions. Your groceries, rent, and utilities become more expensive. You feel the impact in real life immediately. For young professionals or students living paycheck to paycheck, this is stressful. It triggers a kind of financial anxiety that isn't just about numbers, it's about control. People often react emotionally. They spend more quickly, hoard cash, or make risky investments in panic. Unfortunately, these reactions often worsen the situation, so the problem is twofold. First, your portfolio might lose value simply because the currency you hold is dropping. Second, typical safe investments like bank deposits or local bonds may not protect you because they are tied to the same currency. Most financial advice assumes a stable currency, but that assumption doesn't always hold. That's why understanding currency risk is critical for anyone building wealth early in their career. Now, let's put it in numbers. Suppose you invested $10,000 in your local market. If your currency drops by 25% relative to the US dollar, your portfolio is effectively worth only $7,500 when converted to a more stable currency. Even if your local stocks gain 5% during that period, you're still down overall. This isn't a theoretical exercise. It happens, and it can undo years of careful saving if you aren't prepared. Here's the first mindset shift. Protection isn't about chasing the highest return. It's about understanding where risk lives and making choices that reduce your exposure. Most people think diversification within their local market is enough. Buying several several local stocks or bonds may reduce individual company risk, but it does nothing if the currency itself loses value. This is a subtle point, but it's critical. Currency risk is systemic. It affects everything tied to it. Another mindset adjustment is to see risk realistically. You can't control the global economy, but you can control how much of your portfolio is exposed to it. The goal isn't to avoid all losses. It's to avoid catastrophic losses that can derail your financial goals. Think of your portfolio like a basket of fruits. If you only put apples in it and suddenly a disease affects apples, your entire basket suffers. Diversifying your basket apples, oranges, bananas reduces the chance that one problem wipes everything out. Currencies work similarly. If your savings and investments are only in one currency, a devaluation affects everything at once. If you spread some of your exposure to other stable currencies or assets that aren't tied to your local money, you reduce that risk. Even small adjustments matter. A modest portion of your portfolio in a foreign currency or international fund can act like insurance. It doesn't make you rich overnight, but it cushions the blow when your local currency falters. In the next part, we'll explore realistic strategies that don't require complicated financial instruments or risky bets. These are methods that an early career professional, student, or young earner can understand and implement without overcomplicating life. We'll also look at the trade-offs. Every protection comes at a cost, whether in lower returns or more complex management. Understanding those trade-offs is key to making calm, rational decisions. So, if you've ever worried that your savings aren't really safe, or that a sudden change in the economy could wipe out months of work, stick around. The next section will break down the steps you can take to protect your money in ways that are practical and grounded in reality. By the end of this video, you'll see currency risk clearly, understand why most people underestimate it, and learn how to build a portfolio that isn't just about returns, but about resilience. Currency devaluation isn't just a story for economists or people in faraway countries. It can touch your life quietly, suddenly, and completely unexpectedly. Knowing about it and planning for it isn't about panic, it's about clarity. And that clarity, even in small steps, can make the difference between feeling helpless and feeling in control of your money. In the first part, we looked at what happens when a currency suddenly loses value and why it's such a quiet but serious risk for anyone starting out in life. Now, let's shift from understanding the problem to practical ways you can reduce that risk without overcomplicating your finances. Remember, this isn't about chasing the highest return or jumping into exotic investments. It's about protecting what you've already worked hard to earn. The most straightforward way to protect against local currency devaluation is to hold money in more than one currency. For example, instead of keeping all your savings in euros, you could keep a portion in US dollars or Swiss francs. These currencies tend to be more stable, and if your local currency drops, the value of the foreign portion doesn't fall in the same way. You don't need to go overboard. Even 10 to 20% of your savings in a stable foreign currency can act like insurance. Think of it as a safety net. You're not trying to make a fortune, just preventing a big loss. There are practical ways to do this without complex banking setups. Some online banks and apps allow you to hold multiple currencies in the same account. International ETFs or funds can also provide exposure to stable foreign currencies indirectly. Another approach is investing outside your home country. If you buy shares or funds listed in other countries, your portfolio isn't tied entirely to your local currency. For instance, if you invest in a US stock index fund while living in Europe, even if the euro drops, the value of your US investments in euros may increase or at least cushion your losses. The key here is not to try to predict which currency will rise. Instead, you're spreading risk. Just like diversifying stocks protects against a company collapse, diversifying currencies protects against local money losing value. It's also worth noting that international investments have other risks, like different regulations or taxes, but when done carefully, they're one of the simplest ways to protect purchasing power. Historically, certain tangible assets hold value even when currencies drop. Real estate, precious metals like gold, or even commodities can act as a buffer. Gold, for example, is not tied to any one currency. When local money falls, gold often rises or holds value. Real estate in a stable location can provide both income and long-term protection against inflation or currency swings. You don't need to buy huge amounts. Even a small allocation in these assets can make a difference when your local currency weakens. Think of it as another layer of insurance, not a way to get rich fast. It might not seem obvious, but how you handle debt can protect you too. If your income is in a currency that may devalue, having loans or mortgages in the same currency can be risky. Let's say you earn in your local currency and it loses value. Your debt might feel smaller in nominal terms if it's in foreign currency, but if your repayment is tied to that local currency, suddenly your ability to pay could be strained. The practical takeaway: be aware of which currency your obligations are in. Avoid Avoid taking foreign-denominated loans unless you have income in that same currency. When money is losing value quickly, flexibility is key. Rigid savings in one place can be a problem. Try to maintain options, accounts where you can move funds, investments that can be liquidated if needed, or income streams that aren't tied solely to one currency. For example, if you earn some income in euros and some in dollars, you're naturally hedged. Or if you have a small emergency fund in a stable foreign currency, you won't have to sell local investments at the worst moment. The idea is simple. Liquidity gives you choice, and choice is what protects you when currencies fluctuate. Every protective step comes with trade-offs. Holding foreign currency may earn little to no interest. Investing internationally may feel more complicated or carry tax implications. Tangible assets like gold don't generate monthly income. The key is not to avoid these trade-offs, but to accept them consciously. You are paying a small cost for peace of mind. That cost is often much smaller than the potential loss from a sudden devaluation. Think about it like insurance for your portfolio. You hope you never need it, but it's worth the expense for the security it provides. Let's go back to Anna from part 1. After experiencing a sharp currency drop, she starts small. She moves 15% of her savings into a US dollar account, invests a small portion in an international ETF, and allocates a little to gold. The next time her local currency dips, Anna notices that her losses are limited. She doesn't make huge gains, but her savings don't evaporate overnight. She feels calm because she understands her risk and is prepared for it, instead of reacting in panic. This illustrates that protection doesn't need to be complicated. Small, thoughtful steps can have a big impact over time. Protecting your portfolio from a sudden currency devaluation is not about speculation or chasing exotic investments. It's about clarity, awareness, and small, deliberate choices. Diversifying currencies, considering international investments, including tangible assets, managing debt wisely, and keeping cash flow flexible. These are all practical ways to reduce the risk of sudden losses. The bigger lesson is mindset. You can't control global events, but you can control your preparation. By understanding where risk lives and planning calmly, you give yourself security and confidence, even when the world around you feels uncertain. Remember, wealth isn't just about growth, it's about resilience, and resilience is built by protecting what you already have before chasing what you want.